Live from the commodity desk at CNBC Global Headquarters, this is Futures Now. I'm Jackie DeAngelis. Welcome to the show. Brian Stutland and Anthony Gazunda are your traders today. They are here to break down what has been an exceptionally busy week for the markets. Here's what's coming up on the show. It's been an incredible run for the markets, but one top strategist says that the Trump rally has gotten way too far ahead of itself. He's going to be here to tell us why. Plus, crude oil dropping to a 3-week low today. Is this a sign that OPEC's production cuts will have little impact long term? Our traders are going to tell you. But first, the market rally on pause today after yesterday's record run following Donald Trump's speech to Congress. Is this a sign that the Trump rally is about to be derailed? David Stockman is the former OMB director under President Reagan and the author of Trumped, A Nation on the Brink of Ruin. He joins us now by phone. David, great to have you with us.
Very happy to be with you.
Let's talk about the market surge that we saw. Market investors liked what they heard from Donald Trump on Tuesday night. What are your thoughts?
I think the Wall Street is totally misreading Washington. It's pricing in a fantasy about a Trump stimulus that simply isn't going to happen. There will be no big tax cut. There will be no $15 or $20 a share reduction in the corporate rate. Infrastructure stimulus.
David, how do you know that?
Because we're heading into a debt ceiling trap that will grind the whole system to a halt by June or July. People are forgetting we've been on debt ceiling holiday. That holiday ends
right. Well, that's
on March.
Not necessarily new to Donald Trump. That's
no, it is totally
from the predecessor.
It's totally new to Donald Trump. He tweeted last weekend that he had reduced the debt by $12 billion. It's actually up $187 billion in the first 35 days that he's been in office. The cash on the Treasury's balance sheet, and this is the key point I'm trying to get to, was $382 billion the day he was sworn in last Friday. It was $178 billion. It's bled $200 billion of cash, a fifth of a trillion, while he didn't even have his economic team in place. When they get to March 15 and the debt ceiling freezes at $20 billion, or $20 trillion, they'll have maybe $200 billion of cash. That is being run out $3 to $4 to $5 billion a day. By June, it will be gone, and there is no pathway, I will assert, to a majority in the House or Senate to pass a debt ceiling increase in the trillions in order to make any of this stuff possible.
Well, that's what I wanted to ask you. And let me just respectfully push back here. I'm not taking a side either way. But some would argue that Trump's whole negotiation tactic, it all resides on what we've seen from him in the past. For example, his book, The Art of the Deal, how he comes to the table to put a deal together. He's also leveraged himself before. Could it be that he's looking at a different way of running the system than we've seen before?
He might be, but that makes it even more dangerous and reckless. This isn't Atlantic City casinos in the junk bond market in 1991. This is the big time. This is $20 trillion of debt, and this is a House Republican majority that doesn't exist. That's a delusion. It's a gang of factions. They're already beginning to splinter and fracture as a result of the Obamacare repeal and replace, which, by the way, is going to spill much blood over the next 3 or 4 months, and they won't even get to tax reform before the debt crisis hits. We will have a government shutdown. It is totally unexpected, unpriced in, as they say by Wall Street. It will spook everybody, and Trump is so reckless that this could go on for days or weeks or months in a way that we've never seen before. The 2/11 crisis with Obama will be a Sunday school picnic compared to what's likely coming down the pike. So the speech Tuesday night was irrelevant. Besides that, it was the most irresponsible fiscally speech given by a president since, LBJ talked about guns and butter. How can he possibly raise defense by $50 billion, more for veterans, the $1 trillion, infrastructure program, more for education, medical credits, all the rest, and then cut taxes by $3 to $5 trillion, which he also promised? This is
David,
complete madness, I'll tell you.
Let's talk about the markets for a minute, because he is taking credit for the run that the Dow has had here, and a lot of people are saying that's a big mistake.
I think he'll rue the day he took credit. You should never predicate what you're trying to do for the long run, as well as intended as he might be, on what the robo-machines are doing in the short run, and that's clearly what's running today. The robo-machines can read words, and therefore when he speaks, they hit the buy key, but they can't read the tea leaves in Washington because it's far more complex, far more opaque than the stimulus the machines are used to. The stimulus the machines are used to comes from the Fed. The Fed is simple, transparent, stupid, and predictable. Washington is absolutely the opposite. They think the baton is being handed off to fiscal, and it is not going to happen.
Brian wants to jump in here, David.
Okay.
Okay, so, hi, Brian Stutland here. So
Yeah, Brian,
here's the
yes.
one question. 2012 to 13, we had the fiscal cliff worry, and we had a House divided. We had Republicans in Congress, we had a Democratic president, and yet they somehow managed to raise the debt ceiling and get through that time. Why do you not think, when you have a Republican Congress, a Republican president, that we just simply won't raise the debt ceiling, figure that problem out, and yes, maybe we'll live in a higher interest rate environment because it's going to be more expensive to borrow money, but why can't that happen?
Because you now have a Republican president and a Republican House that is not about to start a bipartisan negotiation like Obama did with Boehner. The reason that the Freedom Caucus exists today and that the Tea Party is still half of the back benches is they believe they were sold out time after time after time by Boehner and the Republican leadership, and that's how they passed the debt ceiling. Now, Trump has declared war on the Democrats. He's declared war on the border, on immigrants, the deportations, all the rest of it. The Democrats are not going to deliver any votes, in my view, for a debt ceiling increase unless he throws in the towel on Obamacare and on border control and all the rest of it, which he won't do because he would have a revolt on the right. The politics today are 3 times more fraught than they were in any of the years that you mentioned when we barely got through in prior times.
All right, David, final question to you. You say the market's going lower from here. How much lower?
Who knows? I think there is a massive fantasy built in that an economy 92 months into an expansion, almost the longest in history, can suddenly get up on its hind legs and start growing again. Profits are still down. You know, they're in the last 12 months, they're still about 10 or 12% below the peak in September 2014. I see nothing to reaccelerate the economy or profits, and I see a huge mess, bloodbath, fiscal stalemate in Washington that will remove any of the stimulus that the traders are expecting from infrastructure and big tax cuts and all the rest.
All right, David Stockman, thank you so much for calling in. We'll talk to you again soon.
Very good. Thank you.
Grizz, let's get to it. One thing that's been extremely volatile here, certainly as we've seen stocks soaring, is the bond market. So how do you want to play this?
I'm actually a seller of the June 10-year, Jackie. I'm looking at 123.20 to sell it. I put in my stop at 123.30, and I'm looking for a move down to 122.20. I think interest rates are going higher. David called the Fed, I think, stupid at one point, but all their parameters that they had set have been met or exceeded at this point. I think the economy actually has a chance of being overheated unless they start raising rates and kind of quiet it down a little bit, make money a little bit tighter in this market. When you talk about the debt ceiling being raised, and Brian remembers this, he brought the point up, when the Republicans blocked that from being raised, they were blamed severely in the media,
Yes, they
and they
were.
got slaughtered in the midterm elections.
They did.
Yeah, they got slaughtered in the midterm elections. I don't think the Democrats want to lose any more than they've lost since the first of the year. So I could see them raising this and trying to negotiate at least that part of it.
Brian, your reaction?
Yeah, I think that's what happens. I think they raise the debt ceiling. I think rates move higher because of it, because obviously we're going to have to take on more borrowing. And to Grizz's point, it does seem like Treasuries, higher interest rates are here to stay. I mean, you look at the Fed funds futures going all the way out to the end of the year. We have over 50% chance that we get 3 rate hikes by the end of the year. So we get that. It seems like the 10-year's got to be above 2.5%. So I like Grizz's trade here. I'd be playing it to the short side as well. Or if you're looking to put some bond money into action, hold off, wait for higher rates.
Okay, Grizz, final word to you.
Yeah, Jackie, we're also talking about the liquidation in the bond market, and it's true, it has happened. The Chinese have sold hundreds of billions in bonds, and yet the 10-year actually has stopped its move higher. So the market has absorbed it. I think the market has reacted pretty well up to this point. I don't see the doom and gloom that David has.
Okay, let's get the risk reward on this trade. Grizz is selling the 10-year note, 123.20, targeting a move to 122.20. Each tick in this trade worth $15.63. To be exact, he is risking $313 to make 1,000. Okay, moving on. Let's continue with the theme of the markets here. We just heard from David Stockman about Trump's implications for the market. Our next guest also has some concerns about the so-called Trump rally that we've been following. Mark Eibold, Chief Investment Strategist, Director at Russell Investment, joins me now. Mark, always great to see you.
Great to be here again. Thank you.
I'm not sure if you heard David's scenario of what happens to the market here, but he says we run into a massive debt problem and the market tanks. What are your thoughts?
Yeah, directionally, we might agree with him. I don't think we're as draconian maybe on the U.S. market, but we do think whether you look at valuations in particular, but within our framework of cycle valuation and sentiment, we think there are better bargains in other places around the world for equities. Could the U.S. market continue to go up higher? Sure, but we seem to be priced for perfection, whether it's from valuations, whether it's many of the things being delivered that were talked about in the speech on Tuesday. Almost politically, we're priced for perfection as well, and the rest of the world isn't. So we continue to think that the U.S. might go higher, but we like other places for all those reasons.
Right. The way David sort of described the scenario was like the market is drinking some sort of Kool-Aid here. Look, these investors are not new to the block, and they're seeing something, whether it's in his words, his promises, or even some of the action that he's carried out since Inauguration Day. And just when you think the market won't go up anymore, it does.
Yeah, and that's exactly what we've seen. And now as we get further now into the details and seeing if the programs roll out, I mean, that's where I think the market's going to say, have you delivered or not? And while we are also in the camp, we thought 2 rate hikes starting in May, June. We think March is definitely on the table now. You could enter in a really interesting period where the Fed's raising rates.
Right.
Some of the promises don't get delivered in a market that's arguably at least fairly valued, but we would say overvalued. That's the moment that maybe you start seeing this market move down a little bit. And again, when you look at whether it's central bank policy valuations, we just think and improving economy, we just think that why not move some of that money offshore within a multi-asset framework? Look at what emerging markets are doing this year. And even with 5 elections around the table, look what Europe's doing right now, holding up quite nicely. We just think there's better places to put your equity money right now than the U.S.
All right, looking at a correction here potentially, can you give me a percentage estimate? 5%, 10%? Does the market go down?
Yeah, I mean, we could see as going down as far as 2150, wow. Which I know every day that the market moves up, that gets a little bit further here. And that's a 12-month kind of outlook. So, and we've had that view consistently. When we first said that was only a 5% drop. So the more that this market extends, just the more, again, this perfection is priced in. And we all know what happens when news doesn't get delivered quite the way you expected, when you have really no wiggle room on perfection. So when that'll happen, we don't know. Again, we see all the positive things that are also happening within the U.S., but you can also make that case for those same things developing outside the U.S. Buy low, sell high. That's what we're trying to do.
Mark, we always say on the show, it's like musical chairs. It's all good until the music stops, right? Grizz wants to jump in with a question.
Right.
Yeah, Mark, back to the U.S. and back to kind of what David was talking about. He was talking about Trump's plans and the increase in military spending, and I did hear how he was going to pay for that. I was wondering if you'll concur with that. Maybe I'm just listening to things and I'm just hearing what I want to hear. And the other thing is, do you think that you'll see the gridlock that he's predicting in the Congress as far as the tax cuts are concerned?
Yeah, I don't know if you're going to see as much gridlock as he predicted, but I think if there's any gridlock, again, every day that goes on now look at all the initiatives. I mean, Obama was basically trying to get one major policy through in his first term. I mean, Trump's trying to get through 3 or 4. So there will be more gridlock, I think, than he anticipates. As much as David thinks, I don't think so. I think I'm with you on that one. But any gridlock at all, and that slows this down and pushes it more into 2018, I think at some point, if GDP doesn't pick up, look at the 4th quarter number. It did not get revised upward. It's still at 1.9%. Wages have calmed down. If there's any sort of slowdown in the economy until this pushes through some of the gridlock, I think at some point the market sends a message and says they're done waiting. I just don't know what day that is.
Okay, Brian?
Well, my question, you just mentioned GDP and growth. Now, if you look at the earnings picture and you mentioned valuations are getting a little lofty here, I mean, certainly the Dow above a 20 PE is lofty historically, but given the low interest rate environment, given the stock buyback, given the dividend yield that's being paid out on the market, what would you rather own, a 10-year treasury or take your chances over 10 years on the market here? I mean, I'm with you on a little bit of a pullback here, but isn't the bigger picture that the market moves higher given interest rate environment that we're in?
Oh, yeah, if you give me a 10-year picture, I think I always take equities over bonds in that. And we think bond rates will move up a little bit, but not too much. But I think you just rattled off a lot of things. Earnings have to continue to deliver and to improve. Got interesting ramifications. What happens if you get a strong dollar on some of those earnings? So, again, we just think that you have to have a lot of things work out right to take valuations higher in the U.S. You don't need as many things to work out right to take valuations higher there. So definitely equities, but again, more outside the U.S. than inside the U.S., at least right now. And over the next 10 years, I don't know, but I like equities globally.
All right, Mark Ivell, thanks so much. We'll see you again soon.
Thanks, Jackie.
Get straight to it. Brian, quickly, you were trading the S&P E-mini for us. What's the trade?
Well, I have a target of 23.75 on the downside here on the E-mini. So certainly I'm looking to sell it at 23.90, looking for it to trade down there with the stop at 24.05. We're a few handles lower now as the day sort of progressed. So it's a more difficult trade here. But certainly we've gone up so far, so fast here. We've had a hyperbolic move in the market since inauguration of Trump. And certainly it just feels like we need a little bit of pullback. The VIX below 12 feels like people are getting complacent. Now the VIX is down today with the markets down, which tells me people believe volatility is going to subside. We might get some sideways action. And for that, I think the sideways is slightly lower, 23.75 on the downside.
Grizz?
I do like to trade, Jackie. First time up to the market, a big number like 2,400 in the E-mini. I always like to sell it. The market is up, like you said, over 10% since Trump got elected. Consolidations are good for the market. Investors shouldn't fear that. It makes it a stronger base going forward. I think 6 months from now we're higher, but I like this trade right now.
All right, let's get the bottom line on the S&P E-mini trade. Brian is selling here, 23.90. He's looking for a move to 23.75. Each tick in this worth $50, so he's risking $750 to make exactly the same. All right, final topic of the day. Let's end with oil prices down more than 1% today. Grizz, give us your trade. You've already said that you think we can see a turnaround here.
Yeah, Jackie, I'm a buyer here. The April contract, Brian mentioned the level. 52.5 is where I'm going to buy it. 51.60 is where I'm going to place my stop. And I'm looking for a move to 54.50. Jackie, we mentioned how bearish this market is today, but the big picture is OPEC is cutting. The supply imbalance is taking care of itself, and seasonal demand starts in about 3 months from now. That summer demand really kicks into high gear. I think you're going to see those supplies, that imbalance kind of weed itself out or work itself out.
Brian, is that a seasonal trend that you expect every year, no matter what? No changes, no caveats?
Well, I think Grizz is great at playing that seasonal trend. I've heard him in the past doing this show for a couple years now, and certainly that seems like the play. The range has been on the low side, the 50, upside 55 or 56, so to step in at 52.50 makes a lot of sense. Oil volatility index has come down tremendously over the last year, telling me that traders expect this range to continue for a little bit. So you step in with a little pullback down to 52.5. I love it.
Okay, let's get the risk reward on the crude oil trade. He's buying Grizz at 52.50, targeting a move to 54.50. Each dollar in this trade worth $1,000, so risking 900 to make 2,000. All right, that's going to do it for today's show. Brian, Grizz, thank you. Meantime, if you missed anything at home, head to the website, futuresnow.cnbc.com. Everything is there for you. And make sure that you like us on Facebook and you follow us on Twitter. The traders will update their trades there. Otherwise, we'll see you for our next live broadcast next Tuesday, 1 p.m. Eastern. See you then.